Hey, what's up, everybody? It's Friday. Yeah, September 23rd. There's a lot of stuff I want to get to today, and I just want to do it like real calm and composed. I think that's necessary on a day like today when actually it just looked like sheer panic when you consider some of the developments. It was just sheer panic. All right. The day started off kind of normal. I mean, we were looking to open lower the market, and then the news hit that the UK, that's the new Prime Minister Liz Truss and her Chancellor of the Exchequer, they came out with an economic plan which I thought was brilliant. All right, I was not a big fan of Liz Truss leading up to this. I don't like her foreign policy. I think she's a warmonger, whatever. But this economic plan, and it just shocked me even more so because it came from Britain of all places. They came out with a plan to significantly, I mean historically, boost up fiscal stimulus. They're now planning the biggest tax cuts in 50 years, combined with large increases in spending. And not only that, they're going to address some of these inflation problems. For example, they lifted the moratorium on hydraulic drilling, fracking for natural gas. Now, I think this is brilliant, but the market doesn't think so, nor do it looks like the preponderance of investors. But I want to break this down. In any other environment, you would see that anyone would see this as a massively bullish development. And by the way, it is a bullish development, and I think it will play out like that. It's just going to take some time. But given the hysterical, psychotic environment we are in right now, where we have there is a terminal, and again, terminal meaning death, like death. There is a terminal fear of interest rate hikes. Anything pointing to stronger economic growth will automatically be deemed inflationary and therefore leading to higher interest rates, and higher interest rates are terminal, in the minds of investors right now. Not me. And I want to, make a point on interest rates again. Let me just segue right now. I just saw the banking data. We are now bank loans, since the Fed has now put through 5 rate hikes this year, and loans are up $680 billion in that period of time. Loans are growing at the fastest rate in 30 months, okay? 5 rate hikes, an absolute acceleration. By the way, that's an acceleration. It's not like we were up at, a 30-month high in the growth rate. It's been like a parabolic acceleration in loan growth. So let me just, again, as a sidebar, I'm just going to say to you, anyone who argues that interest rate increases result in a contraction in lending, that is patently false. All right. So I raise this point because it is one of the arguments or fears, right? The fear is that rate hikes are going to lead to a recession. We also saw, again, 5th rate hike this week, 5th rate hike this year. The PMI, Purchasing Managers Index in the U.S., the manufacturing PMI was in growth mode. I think it came in, all of them came in, the composite, the PMI for manufacturing, the PMI for services, they all came in stronger than the forecast. The manufacturing is in expansion mode right now. New orders are in expansion mode. Okay, so again, 5 rate hikes, or if you want to say 4, we just had a 5th. Having very little noticeable impact on economic activity. They're still forecasting a positive third quarter GDP, although it might be very, very slim. We're on the we're right on the edge there, unfortunately, because of the tax strain we had this month. And I have some decent news on that, or I should say positive news. Let me just put that out there. Yesterday was another positive fiscal flow day of about 10 billion. I think it was 9.7 billion. So that makes the total drain for September 131 billion. Remember, it was 146 billion, so we shaved a little bit off. But the swimming pool got drained out. We put back in, like 15 billion got put back into the pool. Okay, but we still got a long way to go. But that's a positive development. So when the UK announced this plan, which again, not only do I think is very bullish for the long term, but I put money on it, okay? I bought some British pounds today. British pound got crushed. It opened up like 110. It went down to the 109 handle. It went down to the 108 handle. I bought them on every handle. I bought some in the 110s. And that's against the dollar. I bought some in the 109s, and I bought some in the 108s. And this is like, I'm going to tuck this away. I'm not trading it. I'm just going to sit on these because, if I'm right about this plan, this tax cut, fiscal stimulus plan, it'll take time to evolve, and it'll show up in foreign exchange over a period of time. So I'm not rushing to do anything on this. I'm definitely not rushing to sell out, and I'm definitely not rushing to take any quick profit, number one. All right. Euro got slammed, but the euro has problems. I mean, they're not doing what they need to do. They are in a serious predicament because of the loss of Russian energy supplies. They have sided with the United States and all of the U.S. sanctions, and that is really, really hurting their economy, and it's going to hurt it for the long term because it's almost impossible for them to replace those Russian energy supplies. And I said that we will see the euro probably go down to, I remember it hitting like, I think it was like 80 U.S. cents back in like 2000 or 2001, something like that. I think, we're going to see that again, unless there's some policy shift. One thing, again, let me just do a little sidebar. Italy is electing a right-wing prime minister, this woman, I forget her name. We'll see if there's any changes that come from that. I see her foreign policy stance. I haven't seen anything really, or I haven't been paying that much attention to what her economic plans are, but we'll see. Things are shaking up slowly maybe in Europe, but still very much tied now to the United States and its foreign policy, and that is a big, big negative for Europe. But again, I was really surprised by the UK announcement. It is wrong. I will just say this flat out. It is wrong to just reflexively equate economic growth with inflation. That is wrong, okay? Economic growth, another way to state economic growth is an increase in the output of goods and services. That means more supply. I mean, this was the whole supply-sider economics, theory, that you want to spur economic growth, it'll increase supply, it'll keep inflation under control, et cetera, et cetera. This is what they're trying to do. I think it's really, really admirable, and it's correct. So I'm with it, okay? Let's get to the U.S. market. Now, I see a lot of people, even people that I would say are very rational, very steady in terms of their demeanor, always calm, always cool. I saw one, Jeremy Siegel, who's a professor at University of Pennsylvania. He absolutely lost it today on an interview. I think it was on CNBC. I saw it on YouTube, or at least a little snippet on YouTube. Jeremy Siegel, who I consider to be a pretty good market analyst, stock market analyst, he just went ballistic. I've never seen him so so emotional. He was really fired up and angry about the Fed and interest rates. So here we are again. I mean, it's reached the point. It's kind of, I think the way I see it, it's kind of traversed through the entire spectrum of the investor class. In other words, it went from very amateur people who got real scared about interest rates, then it kind of creeped up along the spectrum to a little bit more sophisticated, then sophisticated people, then people who I would consider very sophisticated like Jeremy Siegel, just losing their minds about this. By the way, let me add right now that Goldman Sachs and Bank of America, they both lowered their targets for the S&P. Basically, they threw in the towel. Bank of America might have been, I'm not sure what their prior stance was. I think S&P, they dropped it down from like, I don't know, 4,500 or something to 3,200, I don't know. But both of them threw in the towel. So you're starting to see now, I think, capitulation, at higher levels. And by higher levels, I mean, these Wall Street banks. Not that they're necessarily higher levels. I mean, let's face it. They're not that good when it comes to forecasting. I mean, they might be good in making markets and making money and putting together instruments so that they could make money. But in terms of forecasting, they're not tremendously good. But anyway, we saw them throw in the towel. So a lot of things seem to be, today to me, the way the move was, and by the way, we took out the June lows in the Dow. We did not take out the June lows in the NASDAQ and the S&P or the Russell 2000. That doesn't mean that can't happen, okay? Because there's still a tremendous amount of bearishness, and this whole rate hysteria, rate psychosis, I don't see that going away anytime soon. And that is, that's the driving force right now. Like, nobody's looking at economic growth. Nobody's looking at these trends. Nobody's looking at the fiscal like what I look at. I just gave you right now some evidence that, we did turn the corner on these flows. They're getting back to positive, although they're creeping back. But still, we went from 145 billion drain, or 146 billion drain. So we replaced 15 billion now. It's something. It's a start. That's what I said was going to happen. I said September 15th, I was looking for 110 to 120 billion drain. We got 145 billion drain. And then I said, once that's over, which I said a couple of days ago, it's over. We'll start to rebuild in a positive way. That money gets spent back out again. It gets put back into the economy. Those balances get put back into the economy. And then, everything starts to head back up. But we are still fighting through this pall, this deep pessimism and fear, psychosis of interest rates. And again, I just gave you evidence. What I try to do here is, speak in reality. I don't just say things like metaphorically, like, we're crashing. I always, as a matter of fact, in all of my courses that I've given in the past, when I talk about mental game, I stress language. Language is very, very important. The way you phrase things, the words you use. You think they might be, innocuous or not important, but they're very, very important. Your brain, your mind reacts to that. When you phrase something, a crash, getting killed, really negative connotations. I try not to talk like that at all. If I do, I correct myself. But that's what you're hearing right now, all right? I lost my train of thought on that, but anyway, Look, I know. We've seen these levels before. We saw them in June. There's a higher degree of hysteria right now than there was. There's a higher degree of psychosis now than there was in June because of the Fed and oh yeah, I know what I was going to say. In spite, and this goes back to what I said a little while ago, there is no evidence right now that rate hikes are impacting in a negative way, particularly in the fashion that we were told we'd see. A contraction. Loan growth has accelerated. Almost 700 billion in new loans. What if the government, now I understand, the government spending is not the same as a loan. I mean, the government spending is free and clear. It's money in your pocket if you get a check. But 700 billion, if that were announced, well, right now in this environment of hyper fear about interest rates, it would probably get the same reaction as we got in the UK. But I'm telling you, that's going to end up being wrong. So how do you play this? Like, I can give you a patent, my response. But that doesn't mean, you're going to be comfortable with that. Okay, a couple of weeks ago or last week, I don't know, I did a video and I talked about alignment. It's important to invest in a way that is aligned with your personality. I see this as a monumental opportunity. And I'm unshaken from this point of view, even given the last couple of days or the last couple of weeks. I mean, the thing, and it's not just, it's not just like blind hope. It's not. I said back in June, I said September 15th, we're going to have volatility. We're going to have problems because it is drained. I look at the numbers, okay? And right now, number one, I understand what caused this. I mean, a guy said to me, I don't know if it was in a comment or something else, hey, Mike, it just shows you can't fight the Fed. And I said, the Fed really, when you think about it, it has very limited power. It has the power to set prices through its rate setting function. And it is a regulatory body, okay? It is a regulatory institution. It regulates the banks and the financial markets. That's it. If you want to strip it down to what it is, that is it. So I said, no, it's not the Fed. But when you cut 1 trillion of fiscal support, that happened at the beginning of the year, boom. Checks stopped going out, spending was cut. 1 trillion like this, how many times I got to say it? You're going at 200 miles an hour and you slam on the brakes and throw it into reverse at the same time. Now, if you want to completely ignore that like it never happened and it has no consequence, then fine, that's up to you. You don't need me. Just keep, whatever anyone says about monetary policy and the Fed, just do that. You don't need my channel. All right? I don't help you because you have an ideology and you just want to stick to that. I'm telling you that the powers of central banks are they're banks, special banks, yes, but they're banks. They can lend. When they lend, it creates an asset, it creates a liability for both the borrower and the central bank. And maybe a more important function or a more unique function. And it's not even unique because banks, when they lend, they also set prices. Like, what's the price of a car depends on how much a bank will finance, okay? So, or how much a bank will finance the production of that car. So banks, they have price setting, and the central banks have the ultimate price setting through the rate mechanism, and they regulate. But that's it. That's it. Don't make more of it than it is. But when you cut $1 trillion right away, boom, take it away, and you pretend like that doesn't mean anything, it's because the rate's at 3%. I mean, come on, who are we fooling here? You're only fooling yourself. You're not interested in understanding anything. You're interested in buying into an ideology. Let's face it. So that's the story, folks. Got to put a little, patience in here. We've seen these levels before. Okay, the Dow made a little bit lower level. I don't know where it closed. It didn't close on its worst levels. But I see things getting better. And again, it's not even that I don't pay attention to the rates. I do. I see they've gone up. But I also understand that means a transfer, an income transfer to people and institutions, okay? And I also see that it has had zero impact on accessing credit. And I also see that credit demand is very strong. That is not indicative of a weak situation. I mean, I go around here in New York City, the restaurants are loaded, stores are, jam-packed. I was traveling recently, the airports were jam-packed, the planes were full. I don't know. Am I stupid? That doesn't seem like a recession to me. It seems like everybody is freaking out over central banks and interest rates. And it is, I don't even have a word for it anymore. I've used psychosis, I've used delusional. Irrational is too mild of an adjective. So yeah, that's it, folks. Anyway, it's Friday. It's been a crazy week. Be strong. I'll see you. Bye.